Hi there, thank you for taking time to watch this video. In this video, I go over my returns up into Q2 2021. I go as far back as November 2009, because that's when I got records from, detailed records from. And I also look at two things that us as investors do that tend to reduce our returns. And I'm going to correct the problem I have with these two issues in this video. I'm going to show you how I'm going to do that. Okay, let's get into it. The content of this video does not constitute investment advice. Do your own research. If you do invest in anything mentioned in this video without doing your own research and the share price goes down, you only have yourself to blame. However, if the share price goes up and you want to give me some credit, I'm happy with that. Q2 2021, my returns up until the 30th of June, H1 basically. I'm also going to look at two things investors do that reduce their chance of returns. I'm talking about myself as well. I've done this so many times in the past, and I'm going to correct it in this video. In fact, I've been starting to correct it for a while now. I'm getting there slowly. Of course, with any issue, it takes a while to readjust in some way. But these two things are basically this: overtrade and over-diversify. That's what a lot of investors do. That reduces their returns, and I'm going to correct this. But let's look at overtrading, okay? This is a book worth reading. It studies, and this is called 100 Baggers, this book, but it's based on a book by Thomas Phelps, a study of 365 companies that did 100 times their initial price and, of course, mammoth returns, and looked at the qualities they had, but what you had to do to achieve that kind of return. Of course, you don't need any, I'm not saying I'm looking for 100 bagger, I'm not saying that, but even if you get half of that success or a quarter of that success, that's a major return, or even a tenth of that success of 100 bagger. It's a major return. And it's a lot about the qualities of an investor as well, not about the stocks that they're picking, all right? So that's what I'm looking at here. The key is not only finding these 100 baggers or these 10 baggers or these, companies that can multi-return, it's with keeping them. That's the issue. There are plenty of people who have found stocks. I found lots of stocks that have done multi bags. Did I hold on to them? No. So I've got to correct that. I've got to look at the companies and realise the movement has started. A lot of times down to patience, I just haven't stuck with it. I've been early on in the theme, a very hot theme. That's one thing all these stocks have in common, a long-term mega trend. It's not going away for in 1 or 2 years. It's going to be with us for like 5, 10, 15, 20 years at least. But in this book, it's a great deal of investing is on par with the instinct that makes a fish bite on an edible spinner just because it's moving. It attracts attention. And that's why you see stocks coming down. The ones that are rising attract attention, and people jump out of their stocks they have because they're not going anywhere. So that investors too bite on what's moving and can't sit on a stock that isn't going anywhere, even though the business is improving underneath. It'll catch up. The share price will catch up, all right? They also lose patience, I've done this, with one that's moving against them. I did that with many a company. Just got bored with it, moved out, it moved higher. And I knew the company was improving. I just lost patience. I'm not going to do that anymore. This causes them to make a lot of trades and never enjoy truly mammoth returns. That's it. If you're trading for like 10, 20, 30, 40%, you're not going to get that multi-100% return. If you look at 20% returns, investing shouldn't be like that. It should be sit and just read updates, quarterly updates, half-yearly updates, full-year updates, trading updates, but not trading in and out on a daily, weekly basis. That's stressful. That's not the way life should be. You should find a good company, sit on it. So buy right and hold on. So how do you know if you bought right? I mean, I use it as just a sales metric, sometimes a valuation metric, but I also have a 9-filter system that I look through to make sure the company is ticking these quality filters, And if you get that and you bought it right, just hold on. If it's, it's a company in a hot space, a growing commercial market, and it's valued correctly at the moment, hold on. If it doesn't move, it will move if it keeps improving. Over-diversifying. A lot of investors, I thought when I first started investing, how many stocks to have? And you get some older investors saying, you need 20 stocks. You don't. You don't need 20 stocks. You don't need any of that. If you want to make money. If you just want to beat the bank, 20 stocks. If you want to make money, you've got to have a lot less than that. There's no point investing in a company if it doesn't have the ability to transform your portfolio's value. And I mean that. There's no point just buying another stock, adding to your collection, if it can't really transform your entire portfolio value, okay? Thomas Phelps in that book wrote, be not tempted to shoot at anything small. You know, the idea being you want to focus your capital, and that's it. You've only got a limited amount of capital. You've got to focus it on stocks with the potential to return 100 times. Now, I'm not saying you look for 100 baggers, because that's, you know, no one spots a 100 bagger. No one. Okay? You may spot a good company that gets better and better and better, and in the end it's a 100 bag, but no one spots it because it's too far off. I mean, the average time for 100 bag in that book was 26 years. So you may spot a company that's undervalued and growing. That may double, that may triple, but that keeps going, you know. And as long as they keep improving and growing, the flywheel builds up, you know, more people invest in it. So you're never going to spot, I mean, it's a ridiculous thing to look at, 100 bag, I know. But in the book, it said, look for companies that can genuinely scale, you know, and go somewhere. So you have to, one of the rules is you have to look for them first. And I wouldn't say 100 bagger. I generally looked at 10 times, you know. If you can get it 10 times, it's possible it can go further. But realistically, you've got to look for them. Don't just look for companies that give you, what, 10%, 20%, 30% return. Why? What's the point of that? Boring. And if you diversify, that's 30% amongst lots of stocks. It's nothing. So you don't want to own a zoo of stocks and ensure a mediocre result. That's the thing. You know, this is Warren Buffett here. Diversification is protection against ignorance. It makes very little sense for those who know what they're doing. I mean, if you own a lot of the market, you can't beat the market, you know. So you've got to pick individual stocks. You've got to specialize and find good stocks and stick with them. Buy them right, stick with them. And of course, you've got to know how to find what is a good stock. That's another thing. Check out my Share Pickers Investment Club for more stuff there. But you know, that's subjective as well. And he also said diversification may preserve wealth, but concentration builds wealth. Absolutely true. And he also said this: I can't be involved in 50 or 75 things. That's a Noah's Ark way of investing. You end up with a zoo that way. I like putting meaningful amounts of money into a few things. Me too. And you're more likely to know, you know, 5 companies better than 10 or 20 companies. You know, I mean, it's a lot easier to do deep research on 5 companies than 10. Even 5 companies, there's enough to look through. 10, 20, 30, you can't keep an eye on those. And that's ignorant, essentially, you know. So specialise, deep research on a few stocks that you have conviction in. That's the way to get good returns. These are some outstanding investors in that book. And if you look at these people have billions of assets under management, you know. We're talking lots of money, lots and lots of money, not like 10, 100 grand, billions. And look at them. Seth Klarman, 93% of his portfolio is in 10 positions. We're talking billions here. Kyle Bass, 6 positions. ESL Investments, Eddie Lampard, 4 positions. Munishi Pabri, 7 positions. Fairfax Premwater, 98% of the portfolio in 10 positions. Pershing Square, Bill Ackman, 7 positions. W.L. Ross & Co., Wilbur Ross, 4 positions. Fairholme, Bruce, 8 positions. Now, if you think, right, I got 10 positions. Yeah, but they got billions. That's the difference, you know. So, you know, if you extrapolate that out, that'd be equivalent to say the average private investor having, like, you know, sort of 100 stocks. So, them having 100 stocks, the private investor. So if you see what I mean, they've concentrated all their money into few positions, considering how much money they have, and that is the way to outperform. And it also comes down to what's your appetite for risk and reward, you know. So let's look at risk. If you hold 20 stocks, I've set this up. I'm assuming all stocks are around about the same weight in your portfolio. I mean, you know, equal amounts of money invested in them. If you hold 20 stocks and 1 halves, your total portfolio value goes down by 2.5%. Are you happy with that? Yeah, it's not a big hit, is it? And half is a big hit, you know. We set a profit warning on Biome. That dropped by 23% and went up and then bounced back by 6% the next day. So even on that, it only went down by, 18%. So I'm talking a 50% drop, which is massive. Your portfolio would go down by 2.5% if you had 20 stocks. If you had 10 stocks, that would go down by 5%, of course. And if you had 5 stocks, that would go down by 10%. So are you happy with that? If you've done due diligent research, deep research on a few companies, hopefully you won't ever have that 50% hit. I'm not talking about oil and gas stocks or clinical trial biotech companies are going through clinical trials. They're very risky. I'm talking about decent, revenue generating companies that heading towards profitability, have cash, all that stuff in growing markets, valued quite nicely. So if it drops by 50%, it's quite an extreme drop. Your entire portfolio value goes down by 10%. That's all. Right? Let's look at a reward. Again, if you hold 20 stocks, one stock doubles, your portfolio goes up by 5%. Really? A doubler is quite hard. It's hard to get a company to go up by 100%. And then your portfolio would only see a 5% gain. If you own 10 stocks and one doubles, total portfolio value goes up by 10%. All right? Assuming everything else stays the same, of course. Is that enough reward for a doubler? For me, if you own 5 stocks, one stock doubles, your total portfolio value goes up by 20%. All right? Look at this. If you 10 bag and you hold 20 stocks, your total portfolio, 10 bag. Many people will not have a 10 bag in their life. So it's a huge achievement to get a 10 bagger. It'll only go up by 50%, your portfolio value, if you own 20 stocks. I want more reward than that. I'm prepared to take on more risk to get more reward. And that's what it's down to. Again, 10 stocks, it goes up by 100%, decent. But you found a 10 bagger, that's gold. I want my portfolio to go up at least 3 times in value if I get a 10 bagger. It's got to be a meaningful amount of change in my portfolio. So I'm happy with this reward. Basically, 5 stocks. I don't know why I put that there. 5 stocks is mine. 5 stocks, sorry, here. If you hold 5 stocks, one halves, your portfolio goes down by 10%, goes up by 200%. That's me. 5 stocks. And look at this. Look at it returns on those. So I'm talking about, if you own 5 stocks and you double one stock, then your portfolio value goes up by 20%. So if you look at returns, if you add £1,000 a year to your portfolio and you do 20% a year and you start off with 10 grand, in 20 years you got £500,000. That's a decent return. That's going up by 20% each year and adding £1,000. 25%, you're talking about 1 million off £10,000. If you go down to one, over 20 years, 100 grand, is that enough to retire on? 100 grand? Not really. Not really with inflation, So you've got to aim for 20% plus. And that's why you need to have your portfolio value, in my mind, and portfolio numbers of holes lower than we think generally. And have deep conviction, do lots of research. So I'm going to hold my high 5 conviction stocks for 5 years. That cures impatience, overtrading, and over-diversifying. Why? The hardest thing to do is nothing. There's approximately 100 billion cells in the brain, each with connections to 1,000 other brain cells. The brain might be capable of executing 100 billion operations a second. This is why it's hard to do nothing. We're hardwired to do something. Your brain is firing at all, a billion times a second. But it provides the best rewards. If you want big rewards, you buy right, hold on. That's what you do. So as long as you have growing companies and improving companies and you buy right, hold on. These are my high 5. Biome, Escape Hunt, Gfinity, Polarean, Trufin. I'm holding those for 5 years. I've had Polarean for 2 years already. I think I've had Gfinity for a year. I've had this for about 10 months. Biome's a new one. I've added to the hopper. Same kind of level I bought with Escape Hunt, Gfinity. It's done really well. Run about 2 times sales, the valuation. They've got cash in a growing market, bioplastics. These are the market caps, by the way, of the companies. Biome there, I've added that. So obviously they're all growing. And Biome's here. That's the next one in. I'm holding them all for 5 years. So here's my returns after Q2 2021. In Q2 alone, 3 months, I did 22%. And in fact, it was better than that. Started tailing off towards the last few weeks. Hopefully we'll get a rally in Q3 somewhere. But again, it's still hard work at the moment. But it was higher than that. H1 this year I've done 62%, the first half. Last 12 months, 213%. Last 3 years, 686%. Since 17th of November 2009, 8,425%. That's 85 times my original portfolio value. Plus the stocks I sold too early. These are the ones I've covered on videos and blogs. 30 stocks here. I say Escape Hunt's in top 3 now. Polarean will be up there as well. They'll all be up there. I have confidence in these stocks will all be up there. They'll all be up here. All of them. All I have to do is nothing. That's all I have to do. So return on the 30 stocks I've covered. If you'd invested £1,000 in each, as you see there, £1,000 in each, you'd have got profit would be 51,000. Total portfolio value would be 81,000 and 173. So even doing nothing, you've done very well. You're sitting on all the stocks, but it's too many, you know. Thank you very much for watching. If you enjoyed this, by all means, give it a thumbs up and share it if you could. If you want to ask me a question, please do so below. I've got to say, I'm not very good at getting back to comments on YouTube. But also, you can join my Share Pickers Investment Club, in which you can talk to me, on our chat group as often as you want, and also other members there. There's a wealth of information, collective information there, and people can help you out there as well. So check it out. Sharepickers.com is the link. Thanks so much for watching.